I'm Martha Stokes. I'm a retired buy-side institution chartered market technician, and I love to share my ideas and educate you. I had a question from someone who came in through some social media and asked me about why the market opened and then ran or had huge volatility, as they described it, which it wasn't. It was velocity yesterday, and why and why the buy-side institutions or the dark pools were buying the stock in speculative mode. And I'm going, oh man, that is someone who is very confused and misinformed. The more I check on the retail news from time to time, I'm astonished at how much misinformation is out there. So I'm trying to clean up that misinformation and give you information that is truthful and tells you what is actually going on. I'm using GS today just because it had a huge spike up today, and we see volume that is extraordinarily long. Oftentimes they will gap it up, which this did happen, and then it runs up. This is a velocity run, and it's very fast and it's moving very speculatively. But why did we have so much huge volume before the market opened? That wasn't the buy side institutions. It wasn't the dark pools. They are long-term investors. They would never, ever, ever trade like this. They don't trade like this. They're long-term investors. They start the bottoms, they build the bottoms, but this is definitely an HFT action. It's the only market participant group out of the 14 market participant groups there are today. It's not Main Street versus Wall Street. I know all of you like to think that it is, but it is not. And you've got to get rid of all of that outdated, antiquated stuff that just doesn't fit our complex market structure of today. This is HFTs, huge spike. What are the HFTs? Do you know what the HFTs are? HFTs are high frequency trading companies. They are programs that run automatically without any human interference. Okay, so they are fully automated. Are they using artificial intelligence? Yes, they are. They have been using it for 2 years. I've been following them. The first year, the HFT AI made all kinds of blundering mistakes in the last quarter's earnings releases and started gapping stocks down that had excellent earnings reports. And then all of a sudden, the retail side news and the retail side analysts going, oh, something is wrong with the stock, you should sell. So they sold down more. Dark pools came in and started quietly accumulating because they're going, wow, this is a bargain stock price, not Goldman Sachs, but just in general. So today we had a big, huge run up. So what happens is the HFTs fill the queues with orders milliseconds before the market opens. You trade on the 1 minute scale. Yes, you type in your order and you click the button and it seems to instantly fill. Well, it fills within a few seconds usually, but it must fill within at least a minute by law. But while all this is going on, while you're typing this stuff in, your broker is lighting, like I've told you before, lighting your order so everybody can see your order. Pre-market orders come in from the brokers. They may be biased to one side or the other, or there may be an imbalance. HFTs are maker takers. They are designated by the SEC and approved so that the ICE, New York Stock Exchange, and NASDAQ exchanges, the major exchanges, have liquidity. Because of the decimal pricing that we've had since 2001, 2002, the decimal pricing was supposed to make the market more efficient. It made it too efficient, and nobody was making money. And so those bandits of those days were going, well, we can't scalp anymore. There's a penny spread. There's not enough money in it. We can't do it. We can't mitigate our risk factors and so on and so forth. So they morphed into high-frequency trading companies, huge, massive computers with a link directly into the exchanges that allows it to move on the millisecond scale, 60,000 orders per second. Okay? And the milliseconds are super fast. So they can fill the queues. HFTs fill the queues in a direction that they are intending to provide liquidity for the exchanges. After they gap up a stock or move it, then other people, as the market opens, retail groups or smaller funds managers or whatever, usually this is a small funds managers run up, and then it's also the small funds are selling. So half of the small funds managers believe that the economy is robust and everything's okay, and half the small funds managers who actively trade their accounts are trying to get out of stocks or having huge redemption demands. So as it moves up, they try to sell to meet those redemption demands because a lot of their clients are not very happy with them right now because they've been trading and they've been losing money. So this is the intraday scale. We're going to go to the daily scale so that you understand. Usually the gaps are pretty substantial. Sometimes they're not. But all gaps at market open, write it down, are due to HFT AI filling the queues with small lot orders to move or drive the open to a certain designated level. Retail traders who are there watching at open and see the gaps chase it. You don't want to do this because that's going to cause you losses. And that's a big problem with a lot of you is you're taking too many losses. And then you write, oh, I'm not confident. How can I be confident? You can't be confident unless you are profitable. You can't be profitable in this modern day market unless you understand the inner workings. HFTs are a huge dynamic. There's just a few of them. There's not a lot of them, but they have a massive influence on the market open. Who has a massive influence on the market close? Professional traders, because they have their end of day open cry. It's called open cry, but it isn't. Auction where they trade amongst themselves and trade against you, whatever you're doing at the end of the day, if you're closing or not, or whatever you're holding, whatever you're doing. And they're juxtapositioning for the next trading day because they have knowledge about the next trading day that you do not have. You wait for retail news. You wait for the chat groups. You wait for other people who are gurus on social media to tell you what to do. You need to have the charts tell you what to do instead of relying on people, because the charts will tell you what is going on before a big event or before a big push. Goldman Sachs has been moving up quite speculatively, and it is growing. Why is it growing? Why is it having a huge activity and a lot of buying and investing in it? Because everybody thinks that Goldman Sachs is going to be a major underwriter for one of the three big, huge IPOs coming out. And that's a whole nother story we'll talk about later. Right now, we're talking about speculation versus HFT front running or providing maker taker liquidity to the exchanges so the exchanges can make money. Everybody that's a retail side says, well, I don't want to pay for anything. Well, everything in the market costs money. And if you think that you're getting everything for free, think about how many losses you've taken. How many losses have you taken because you don't understand the dynamics of 14 separate market participant groups that are each doing things differently from the other? And you're thinking, oh, it's the little guys against the big guys. No, it's not. You just happen to get in their way. And you're doing it a lot these days. You're getting in their way. We have a strong bull market. It's not anywhere near a bubble. It's going to have waves and corrections. Look at Goldman Sachs. It's doing very well, and it has a platform position right here. Then it moves up, then it corrects a little bit and moves up and corrects a little bit and moves up. This is the dream world of most long-term investors because they can just sit and hold this baby and it'll keep going up and up and up. And maybe they bought it at 570 and now it's up at 1,000. They're happy campers. They're not going to sell the stock. This is not volatility. This is ordinary, everyday action day over day. Okay? So get the notion of a volatile market. This is not a volatile market. This is a normal, young, great bull market. It's still in its infancy. It's only been around about 3 years. So it's got a long, long life ahead because we have many, many new technologies, and AI is helping build and speed up those new technologies. High frequency traders are going to always be around. They're going to gap the stock down or gap the stock up based on what their AI interprets things, that it goes out, and the AI does this beautifully. It sweeps out through the whole social media. It sweeps out through all the chat rooms. It sweeps out through anything that's open and determines where all the emotional traders, retail traders, and smaller funds managers are focused. Then it looks at the cues and it decides whether it's going to fill the cues to the downside or the upside. The computers of the market automatically gap it down or up based on the number of small lot orders in the queues at open. So you want to be prepared for this and understand the HFTs are part of this world and they're not going anywhere. And you can't be trading against them because you will always lose. I'm out of time. I hope I gave you some information that you can think about. And if you have anything that you would like me to discuss in the future, let me know. I'm Martha Stokes, and that's the topic for today.